Don't forget to subscribe to Basement Tales. Just go on Apple, iTunes, or wherever you get your podcasts and hit that subscribe button. We release a podcast every Thursday. That way you'll be sure not to miss an episode. Welcome to Basement Tales with Sam Jackman, Charlie Einsman, Ed Grass, and Sandra Delancey. We have fun telling crazy but true stories about turning the worst possible property disasters into bags of money. Along the way, we'll pass along some important lessons to help you make cash on real estate. Sam and Charlie walked away from cubicle hell 25 years ago. Starting with no property, they created their own Clear Sky group of companies, sold hundreds of houses, bought dozens of rentals, and made millions in hard money loans. I'm Ed, a big firm litigator until muscular dystrophy made me find a hobby other than suing people. I miss it. Sandra's the normal person here with a real job plus some rentals. Her decades of friendship with the group, from office flunkies to property gurus, might help keep us all humble and focused on learning something. I wouldn't count on it. So clearly, one topic we could have today is talking about my excellent 2-martini lunch. Another topic, Sam's got a tale that I don't know, might be our first X-rated basement tale.
It's a basement TAIL.
And then I got a good debtor in possession story too.
Yeah, that's all fascinating. I want to hear about the basement tale TAIL.
So last Friday, we're having a small repair done on a property that I'm monitoring on Ring. And the Ring camera shows up, and I just take a peek to see what's going on. And I see somebody exiting the property. It's the worker that we've sent to it, and somebody else who doesn't look like familiar to me. And the worker isn't supposed to have other people come in the house. So I dig down into what's going on, turn on the speaker and hear what's going on. And they're having a huge conflict. So Sandra saw it. Sandra, why don't you describe what you saw on the video? I think it's...
Well, see, I didn't know that you had the encounter first and then you turned on the video. You just sent me the first video that shows your worker coming up to the door with a person, in tow. And the person looks around kind of suspiciously is the first thing that I noticed. That this person is looking like they shouldn't be there, or kind of checking out the surroundings to see who's, looking at me go into this place. So that's the first thing that I see. And then, Sam sends me 3 videos. That's the first one. It's only about, 20 seconds with this.
That sounds okay.
It sounds okay. Other than that person did look suspicious. I'm like, okay, who's the suspicious woman walking into the house?
And she was a really tall woman.
Really tall woman,
like 6'1".
Yeah, long hair, all that, a woman, but she's looking around like I shouldn't be here. That was my first impression. And Sam didn't prompt me at all on these videos. He was like, here's our basement tale. So then I start looking at number 2 when they're coming out, and that's where the fun starts. So there's a lot of yelling going on, and there's some cursing going on.
Demand for payment
for services that were rendered, but were not.
Did one of them look happy though? Was one of them happy?
No one looked happy.
Frankly,
after what
neither
happened.
one of them looked happy, Ed. Neither one of them looked happy. They were threats to call the police,
So you're suggesting, I'm just going to interpret this because I've not seen the videos on purpose, but are you suggesting there might have been a transaction that took place?
Could have been.
Yeah.
Well, no, there was definitely There was definitely a transaction that did not take place.
They were
fighting about the transaction.
Whether the transaction was actually completed.
Well,
so services were rendered because they were in the house for 19 minutes. They entered and they exited in 19 minutes. So services were rendered, but a transaction had not taken place yet.
That's a lot of
services. You didn't have cameras inside though, so you don't know.
No.
Mm-hmm.
No, but the lady was yelling in a man's voice. So we'll start there.
Well, see, I didn't get there. So I'm wondering why this man is yelling that he's going to call the police on this lady. And then, the man keeps yelling that he's going to call the police on this lady. And then I realized that the man is the lady.
Right.
So the voice that I'm hearing that I thought was a man is actually coming out of the lady. So that kind of confused me too.
And she was demanding payment.
Yeah.
She said she had in her possession a condom.
Oh, wow.
As evidence.
Oh, well, so there was a transaction, is what you're saying.
No. Services.
I mean, I didn't see it.
The transaction hadn't happened because the worker refused to pay.
Oh, maybe he thought it was a consensual
Right.
encounter.
We don't know what the terms of the contract were. You know,
Mhm.
what did they agree on when they went into the house? We don't know that at all.
And in fairness, we don't actually know what happened inside the house, or if there was a condom as evidence.
We might
It
not
was
want to
just-
mention where this house is either, in case
No.
somebody
Oh,
wants
no.
to buy that house
Definitely not.
and doesn't
Okay,
want to
let's-
know what's
okay.
happened in that house.
It's not in Virginia, and it's not in Maryland.
Well, there's nothing that hurts the value of the house here. It's
No.
just
It's not like
just,
a ghost.
right?
That in their house, you know.
Right,
Not that I wouldn't
think,
buy the house because I knew that happened, but
yeah, I don't think a person has an expectation when buying a house that there's never been any, let's call it,
Never.
sexual activity.
never
That's-
any in my house.
I mean, I suppose this is a new house, I guess, but
No,
still,
the house is brand new, and it was brand new.
Well,
staged.
it's
It's
been
staged, brand new,
renovated.
and on the market, by the way.
I
Yeah.
definitely don't want that furniture. That's for sure.
Well, the neighbors have a lot of information because they got engaged in the whole discussion with everybody. And that,
Oh, I didn't hear that
Yeah.
part.
no, those guys out in the
On the
street.
corner,
Oh yeah.
when
So
they
the
come
argument,
out.
so the argument of the non-payment went out into the street, and the one person that was due the money started screaming in the neighborhood, threatening to call the police. And so the neighbors got wind of what was going on, and so they got involved in the
We'll call them the
discussion.
peanut gallery. So the
No,
peanut
the peanut
gallery is
gallery.
across the street. Peanut gallery's hanging on the corner out there, and they get involved.
They have a lot to
They had a
say.
lot to say. And they said it for a long time.
Oh yeah.
Wow.
And oh, by the way, the 19 minutes that they were in the property, 5 minutes after that, a realtor came and showed the properties with a client.
Wow, that was close timing.
Well, wait.
With
The
a very
peanut gallery was still out on the corner.
with a very conventional looking client as well. So they had that client walked in and seen all this other stuff going on. I think they'd been pretty surprised.
Wow.
It doesn't matter, because that said client that saw the house
Left.
write an offer.
They were left right away.
So they did write an offer.
Well, they walked in and they heard the peanut gallery outside and they said,
What's going on?
"Yeah, what's with that?" And
Yeah.
they just sort of looked at each other.
Yeah.
And they were like, "Maybe this isn't our place."
Well, what's interesting about this, I think, is all of these cameras and rings and whatever. This is all relatively new. This stuff, I'm sure, has been going on. Now, like, this wouldn't occur to me, but now I realize, well, this is a nice, clean looking, lovely staged opportunity for somebody to do something like this. And I know what Charlie's concerned out of this is he got no cut of this in any way. And he's thinking that's where he's really upset about it. There's, if you could rent these places, I think this is like a new form of Airbnb, maybe. We're a pretty liberal group here. I mean, we're fine with people's lifestyle choices. Of any or whether choice or nature. We don't have to get into all that, but we're very supportive. We're equal opportunity. I know you guys are. If they'd like to buy the place, these two nice people, you'd be very happy to sell it to them.
That would be better.
Borrowing it's maybe they were considering buying it and just trying out.
Well, when confronted, the worker's claim was that it was a prospective buyer coming into the house, and initially the worker said that nothing had happened, and the voices we heard on the tape, on the video, were just the neighborhood peanut gallery just being engaged on a Friday evening. But when confronted with the video itself, he changed his story and said, "Oh, that was someone I let in to show them the house."
Oh, well, that was nice.
Yeah, I help. That's real helpful for us.
Yeah, real helpful.
Gonna sell. Well, this is
There a
definitely our
contract
first.
written?
No contract written. This is our first crossover. We need to secure the Basement Tales TAILS site, and if you want these kind of Basement Tales TALES, this is a good time to subscribe, because clearly you never know what you're going to hear on Basement Tales. I was shocked by this. And I've heard a lot of interesting stories. So, but everything's good now. The property's fine. It's cleaned
Everything's
up.
good. Oh yeah.
Nothing's burned down. So
No.
just, the fun you can have with real estate.
There it is.
Is
So,
there a
Charles-
moral to the story? Is the moral
Oh.
don't check your Ring's camera or have a Ring camera? I'm not.
No, I think the moral of the story is have a Ring camera so you know what's going on with your properties. Holy crap.
And today's episode is brought to you by Ring Camera. We're going to send a copy to them and ask for a fee. We're not an official provider or sponsor in any way, but we should be. If you're listening out there, Ring, feel free to send us money.
So, Charlie, you got one, right?
Yeah, Charlie's got a more normal story.
Yeah, I have a good normal story, but I think Ed has to do his legalese because it's called a debtor in possession story. So Ed might want to tell everybody out there what debtor in possession means, financing.
Yeah, it's fairly straightforward. When somebody declares bankruptcy, typically a Chapter 11, which is a business bankruptcy, everything goes into the trustee's hands. So say I have 5 properties and a business and I can't make my monthly payments, but it's an ongoing business. I file for Chapter 11 bankruptcy. All of the funds of the company now are restricted. You can't just go paying money out and doing normal business. It all has to be put into trust essentially. And then the court has to authorize payments going out. So a debtor in possession means that effectively you're acting like the trustee. If Charlie owned this business and ran it with 3 other people, he might become the debtor in possession and have a bunch of responsibilities to the bankruptcy court and to the creditors that are a bit beyond what a normal business person has. So Charlie can't say, well, I'm going to sell one of these 5 properties. I think it's a great idea. He has to get permission from the court and do whatever. He might, for example, want to refinance, or Charlie has to pay the insurance on the property. So he has to get the court. Is that okay? Yeah. Then he sends out and pays the insurance and he pays a vendor or whatever. So they call them DIPs, or debtor in possession. And Charlie, I think you ran into a debtor in possession who, as I say, they have all these bankruptcy requirements, but they need financing. They need all the things a normal business has, but they have this extra layer of mess from the bankruptcy. And I only heard part of this, Troy. How did you meet a debtor in possession?
So this is in relation to the podcast on the second lien sandwich.
Mm-hmm.
So a few podcasts ago, we did a podcast on the second lien sandwich where a bidder showed up to the courthouse steps. He overbid on a house, not knowing that he was buying the second trust and that there was a first trust there. So he bought the house for entirely way too high, and he made a mistake, and he gave up his deposit to buy the second trust. So he gave up some money to the trustee to buy the property, but he didn't realize there was a first trust. Well, fast forward this a few weeks, actually fast forward about 4 weeks. He lost his deposit because he didn't realize there was a first trust, okay? The house came back up for auction. The second trust came back up for auction. Well, the guy that lost his deposit showed up at the auction with his attorney. So there was only myself, the guy that lost his deposit, his attorney, and another bidder at the auction. There was only 3 of us. Well, we both showed up about 5 or 10 minutes before the auction, and the guy was asking me a bunch of questions regarding the auction from 4 weeks ago because he lost his deposit. Well, unbeknownst to me at the time, the guy that he brought was an attorney. And so he was a bankruptcy attorney. So, of course, I was answering all the questions they were asking me. And of course, how I always do with these auctions, I give out my card. And so I gave out my card to both the guy that lost his deposit, who I now know he's actually a good friend now, 4 weeks of being a good friend, and his attorney. Well, his attorney ended up being a bankruptcy attorney. Well, the bankruptcy attorney was telling me about a case of one of his clients that needed debtor in possession financing. So, I didn't think anything of it just because I figured, okay, this guy's probably just being nice to me and he's probably never going to call me again or have his clients call me. So I didn't think anything of it. Well, just the other day, I did get a call from his clients. Well, his clients were individuals. And so instead of being in Chapter 11 bankruptcy. They're in Chapter 13, and they're about ready to exit out of Chapter 13 bankruptcy. And so the way a Chapter 13 bankruptcy works is that it's a reorganization for individuals. Well, these guys that were in Chapter 13 bankruptcy need a refinance of a property that's in Chapter 13 bankruptcy. And the property happens to be in North Arlington. And the numbers are like the house is worth like 1.1 million, and they need $400,000 to help them exit Chapter 13, and that will pay off both loans on the property itself. And so that would be considered debtor in possession financing. And so this deal is supposed to close sometime in the next month, but that's kind of where we're doing debtor in possession financing, helping somebody get out of Chapter 13 bankruptcy.
And what's fascinating about this is you can have bankruptcy for all sorts of reasons. And I alluded to it before. You might have assets, but they're not easy to liquidate or sell. And you might have $5,000 in bills a month, but only $2,000 of cash coming in. And you could have $1 million in assets. Well, you can't easily perhaps convert that, or you have other reasons that you're having trouble refinancing, and people end up going into bankruptcy. And as Charlie said, in that kind of bankruptcy, it's a reorganization. It's to stop the creditors at your door, to stop a foreclosure, to sort of pause a minute and try to reorganize. Well, once you file bankruptcy, of course, as an individual there, and even largely as a business as well, your credit's shot. And a normal bank, this would be a very reasonable opportunity for a normal bank to refinance this loan. It's a decent amount of equity. You know, you look at their income coming in or out, but the problem is either from not having enough monthly income, or even more likely from having gone bankrupt in the first place. The bank can't underwrite a loan like that and get it with Fannie Mae or Freddie Mac and do their normal process. So the bank says, sorry, you don't fit in our cookie cutter. Well, now what do? Right? They're running up late fees and everything else on this. And so you need to seek, or you want to seek, often specialized bankruptcy financing, where a hard money lender or an asset-based lender will give you a loan, because it doesn't matter to, say, Charlie, in the circumstance, what your credit score is, or even your cash flow. As long as there's enough money in the property, you know, he doesn't have to meet Fannie Mae and Freddie Mac, situations. And there's some things that you have to deal with. I'm just sort of making this generic. But in the right situation, he can issue a loan. The person now might have 6 months or a year of breathing room. Maybe they have no payments during that time period to then get out of bankruptcy. Well, okay, now I've got, say, $3,000 a month in income and only $2,000 a month in expenses. I exit bankruptcy, I pay all my bills for a year, and then I go refinance out Charlie's hard money loan. I go back to a normal bank and say, look, my income is higher than my expenses. I've paid this debtor in financing type arrangement. And it's a little bit surprising. There's not a lot of debtor in possession financiers, but I think it's because they have to understand bankruptcy and hard money. But it sounds like this situation is going to work out very nicely. I mean, you'll obviously have a good loan.
Yep.
But these people will have financing they're desperate for, which will save them a lot of money in the long run.
You know, and it's funny, and we had this conversation with the owner, and she was so happy that somebody would actually do it. And, she's trying to get a loan through a normal bank. And like you said, there's absolutely no way she's going to get a normal loan. And so, like I said, the numbers are, the house is worth 1.1 million. She owes $400,000 on two, she's calling them equity lines of credit. But what's not apparent to me is why these two have to be paid off, but they have to be paid off. So that just tells me there just must be some, bad blood in the past, and these guys aren't really willing to grant them any more credit because they are normal banks. And so, like I said, the house is worth 1.1 million. They need 400,000. So the way we're going to end up doing it is do a 12-month loan at 500,000. Make sure they don't have to make payments for a year. Let them get back on their feet, get their credit sort of straight, so that they can maybe refinance us out in year two. But if they can't refinance us out in year two, then we'll just go ahead and extend it for another year to give them time to get their credit back in order. It'll be 2 years after the Chapter 13 filing that they're exited. So hopefully they're going to be able to get a loan. But at that time, we're going to be at 500,000, on something worth 1.1 million. So from an asset-based standpoint, we're very safe. And so the actual owners of the house, I can't believe how happy they are. And they're very thrilled. They didn't think anybody would do it.
Yeah, because you look at the more normal financing, but I bet, this is a guess, but I bet what happened is if they defaulted at all. I mean, first of all, going bankrupt can be a term of default on some of these notes. They may have defaulted on a couple payments because of cash flow issues, and then everybody's a bit nervous, right, about the economy. So depending on the bank, they may figure we don't want to extend this. We want these notes to be due, and or unless they bring them absolutely current, we're going to keep hitting them with late fees and overcharges and attorneys fees and whatever else, and they just don't want to keep that on their books. That'd be my guess. I don't know, obviously.
Yeah, and Sandra, they charge for $299 attorneys.
No, 299 attorney. But you're talking about a new area or a new business channel, or I guess it's not new to you all, but we haven't really talked about it before. We used to, you guys, talking hard money lending being fix and flippers or the rehabs and all that. So now you're talking about something different. Like, what type of hard money lending is this? Where you actually
you hit the nail on the head. That's exactly what it is.
Or,
it's definitely a new business channel. And the funny thing is Ed actually created this idea of this business channel. And so that's exactly what it is. It's a business channel that's driven.
It work, Charlie? So how does it work? So I come to you and I get a loan from you to kind of bridge some type of, financial issues that I may be having with my my current mortgage or
sort of. But the key to the whole DIP financing is that somebody is already in bankruptcy. So whether it's a 13 for an individual, it's an 11 for a business, or it's a 7 for an individual or a business, then that's when we would come into this debtor in possession financing, because they already have to be in the bankruptcy courts.
Right. And the thing why there's not that many DIP financiers at this level is it takes some understanding of bankruptcy, right? Yeah. So Charlie can't just show up and, well, I mean, he could, but it would cause problems. He can't show up and say, here's your loan, no problem, sign all this stuff like you normally would, because there's a bankruptcy court involved and because there's bankruptcy rules. So it's helpful to have, at least on her end, this fella sounds like he understands all of that. You need an actual bankruptcy lawyer to make sure you comply with all of the court requirements. And now the court will be thrilled typically. I mean, they'll look at it. The court will actually look at this and say, well, no, this is unreasonable. This person has a different option. This is too expensive. But what will typically happen is the court will say, this is fantastic, because this gives the person breathing room. They can use some of this equity, say, without selling their property. Because the other option for this person, this is their home. They might have to sell their home just because they can't find a financing method. So you have to think of, I mean, they call it sometimes, right, a lender of last resort. Sometimes it can be a lender.
That's what they call us all the time.
LOLR, lender of last resort.
Right. But the funny thing is, it's sometimes the lender of first resort, like for the fix and flip place, because you're not going to find a bank loan typically for that kind of scenario. I guess that means it also is the lender of last resort as well as first resort. And I would say also, too, if somebody's heading into bankruptcy, it's not a bad idea even before the bankruptcy. Like if these people had come to you before the bankruptcy and said, nobody will refinance us because we have, our credit's wrecked, we've been late on bills, we're about to file for bankruptcy, you could do, and you have to be careful with, because if they then later declared bankruptcy, but you could potentially do an asset-based loan to keep them out of bankruptcy. Yeah. So I wouldn't say to our listeners, go out looking for hard money lenders as a first option. But in the right scenario, just like a fix and flipper, if a fix and flipper can actually get a loan, even though it's a 12% interest and 3 points, but then they make $100,000 on that deal and they pay it off in 90 or 120 days. From their perspective, who cares? That's a great interest rate because they got the loan. Mm-hmm. Same with these people. They can save their house. They maybe give up a little bit of their equity and they come out the other end with back to a regular bank loan.
Okay, so just trying to understand how it works after, that first year. So for the
Mhm.
first year, you got the $500,000 loan, you're not requiring that they pay you. But once they get out of or get to a
Right.
point where they can refinance their loan, get some equity out of it, they pay you what they owe you plus the interest that's accrued.
Sort of. So the way it would work in this case is, let's say the house is worth 1.1 million or 1.2, whatever. They need 400,000 to pay off both the trusts. Okay.
Mm-hmm.
So 400,000 is going to go to pay off the trusts.
Right.
Then we need to build in 12 months worth of payments. So let's be simple, right? So on a $400,000 loan, the payment at 12% interest is 1% a month. So it's $4,000 a month interest only payment.
Mm-hmm.
So 4,000 times 12 is $48,000.
Mm-hmm.
So we have to add $48,000 on top of that 400,000. Okay. Then they're going to need closing costs, right? So this loan is going to come with closing costs. Let's say it's 3 points and maybe the fees are 3 points plus $2,000. So 3 points on 500,000 is 15,000 plus an extra couple thousand to close. Let's just say for simplicity's sake, it's $20,000. So you're at 400,000 plus the $48,000 of payments roughly.
Right. Right.
And then you're at another 20,000. So you're at 468. So then we'll just simply give them 500,000 to round it up. And then they'll walk away with approximately $32,000 in cash. Plus they'll have a loan on their house of 500,000 that's been paid up for a year. So they have 32,000 in cash, plus they have 12 months worth of payments already made. So at the end of that year, they're just going to owe us back a straight 500,000, but at least they don't have to make payments for 12 months. So this will give them time, like they got 32,000 in cash out, plus it will give them time, no payments for a year, to hopefully get back on their feet and do what they got to do to help hopefully refinance us out.
Mm-hmm. Right. And they could decide, you know what, we want to downsize. They could market their property in a very positive market right now without the, bankruptcy court having to delay the sale, because that is another option. They could, through the bankruptcy court, say, well, let us spread out our payments and give us 6 months to sell the house. But I'm assuming they don't want to do that.
Right.
But even this financing, after 3 or 4 or 5 months, they say, we're not going to be able to afford this type of house. Let's put it on the market for 90 days, sell it in a regular retail environment for its maximum value, and downsize to a townhouse or a condo or an apartment or whatever. So it's just another way to give somebody more options, some of which can be better or worse. They have to make an assessment. But and the other thing is, you'd have to consult with somebody after a year. They might want to go talk to their regular banker and say, hey, if I do this and my credit now is sort of back in order, will I be able to refinance this in a year? And if the bank says, no, it's going to be 7 years till you can refinance. I mean, probably what will happen is they wouldn't get one of these like 2.5% loans, but they might get a 4% loan from a traditional bank. And again, happy campers because they've had that time to do it. And where this comes from, by the way, as usual, these things are available to big, wealthy people. So, who does this kind of thing is like when the airlines have gone bankrupt, right? So they'll go out and get DIP financing so that they can continue to operate. And what the court will do is that new financing moves ahead of all the other financing that was out there. Maybe it refinances some out, but that helps them continue to fly and sell seats. And it's very sophisticated DIP financing, but that can be done for a small business. It can even be done in some scenarios for an individual if you've got some assets.
And the other thing with us on the first example with the house is that as a lender, we understand that it's probably going to take them more than a year to possibly refinance, because depending upon the banks, what their underwriting criteria is. So even though the loan might be for a year, we're flexible enough that we understand that this could be a 2 or 3 year process. So we're not going to do anything with the borrowers, except once the first year is up, we'll just, maybe add an extension fee onto the current loan, and then they're going to have to start making payments, or we're going to modify the loan. So we understand that at the end of the first year, there's going to have to be another, decision making meeting and figure out what we want to do. Now, hopefully for them, they will have refinanced us out, because in this case it's a 13. And so hopefully the credit will start going back up and the banks will start improving on their underwriting criteria, and we can get out of it in a year. But we understand entering this deal that it's more likely going to be a 2 or 3 year process. We get it. So no problem. And we tell them time.
Yeah, exactly. That's the main thing, is if you're in this position, do your homework. There's obviously a lot of, I wouldn't say a lot of vultures out there, but there are vultures out there. Make sure with a hard money loan, it's a higher interest rate. I mean, 12% for a year is not as good as 2.5% for a year. But 12% for a year is a heck of a lot better than losing your house, if that's your alternative. And 4% is better than no loan. So you just have to look at your options. But in a bankruptcy situation, it gets so hard to get credit that DIP financing is a very specialized thing. I mean, even Charlie could, because of the bankruptcy complexity, I'm sure Charlie could demand even a higher interest rate if he wanted to, because there's relatively few players. I mean, he's just doing it basically the same that we would do in pretty much any situation. But
I'm thinking though, Ed, I mean, this seems like a great, option for the borrower, because I mean, they walk away with their house, they walk away with no payments for 12 months. And although it's asset based, so I know what that means. I'm learning a few things here. Yeah. So the asset is yours if things go south. But I mean, you don't get paid for a whole year. Like, how do you handle that? When I ask these questions, I ask both from the borrower perspective, like if I wanted to do this, and I also ask from the investor perspective, like you guys. Let's say I had $500,000 and I wanted to loan it to a friend who's going through this. I could do that, but that means I don't get paid for a whole year. Possibly 2 or 3 is what you're saying, Charlie.
Yeah, but remember though, you have to think of it this way. It's just a built up piggy bank, except you're not getting the cash flow, right? So really, even though the loan is, let's say 500,000, the amount of money that you're actually putting out there is 500,000 minus, well, the payments I said with 48 is actually going to be a little bit higher, but anyway, it's 500,000 minus the $48,000 of your prepaid payments, minus the closing costs that you would get as a lender. Let's say it's just 20,000. So in actuality, you're putting out 48,000 plus 20 is 68,000. You're only putting out $432,000 for the loan. Get back 500,000.
Mm-hmm. Mm-hmm.
So
and
right with the 432, and you're getting back 500.
Right, it's a great deal, but you have to wait for your money, is what I'm saying.
You got to wait.
You're not getting anything for a year.
Right, but if you're waiting a year for a 12% return on something, plus your points, that's actually a 15% return, a little bit higher. So would you agree to me that if somebody's going to give you a 15% return, you would be willing to wait a year for that money back, right?
Absolutely. Yeah. But I'm just saying, for the investors who don't want to wait, you're not going to get your money back for, a while, maybe 2 to 3 years.
Yeah, that's true. It could be 2 to 3 years.
Right. Well, think of it from the investor standpoint, kind of like a certificate of deposit at the bank. Like if the traditional certificate of deposit, you give the bank that same 400 some $1,000, and whatever the rate is now, 2% or something, and you can't have that money back for a year. Now you're totally protected because of whatever the federal backstop FDIC is, right?
FDIC.
So there's literally no risk or extremely low risk. But for that reason, you get 1%, 2%. Here, Charlie maybe nets 15% on his money. Maybe it's out of his hands for a similar time period. But the risk, if somebody wants to go into this line of giving out the loans, is you've got to know the property has that underlying value. You have to be prepared if it turns out that these seem like great people, but so you get a bad lender or bad borrower who's acting in bad faith, and they try to just disappear, or they didn't even own the property in the first place. I mean, there's steps that you have to take to make sure that the loan has an actual deed of trust documents. They're legally appropriate. They're filed, with the local registrar, and all of that's doable even for an individual person. But each step sort of limits your risk. Charlie will require that they have fire insurance. what if the property burns down again through no fault of theirs? I mean, that happens.
Yep.
Well, then you have to have insurance so that it pays off the lender, just like I'm sure your home right now has that sort of insurance. So there is definitely more risk. But if you're an experienced hard money lender, you can pigeon off those so that the extra risk between the certificate of deposit 1% and the 15% is a risk worth taking.
Yeah, and then the other risk too is we get a lender's title insurance policy as well, in case the title company missed something on the title. So if there's something wrong with the title, we have lender's title insurance as well. So.
And what is that? There's CPL insurance too, isn't it? So that if Sandra comes in and says, I'm Sandra Delancey and I own this property, I'm getting a loan out, but it turns out the property is she's not actually Sandra Delancey. She's I don't know, Sandra Martin, and she has a fake ID. And absconds with the money, then there's another type of insurance, the CPL. So which raises an interesting question, maybe to Charlie and to Sam, is how did you do this? Or let's say one of our listeners has $500,000 and they'd like to get into the hard money business, issuing $100,000 or a $200,000 loan. Is this something a regular person can do or they can get into, or how did you guys start? How do you start?
Sam
doing
always
this?
shakes his head no, and Charlie's like,
No.
Probably.
You send it to us. We'll do it.
Watch that between the two of them. There's a big difference.
Right.
Well, there's a lot of things to set up when you're going to enter the hard money space in terms of just the basics, like how you're going to document it, how are you going to collect it, how are you going to monitor it. So you got to go through all of those processes, and so the deal of doing the loan is great. It's the whole rest of the execution that if you're doing it as a one-off, you don't want to do, right? You don't even want to do it when you do 100 of them. But if you do 100 of them, it makes sense. If you do one of them, it's just not worth the setup, as you're learning too much for the return, right? So you have to plan on doing it on a longer term basis. I think you should be involved in a fund of such things, such instruments. So rely on somebody else, let your money do the work, and you focus on your core business.
Whereas, see, that's the difference, right? I'm more of the riverboat gambler.
Do it yourself kind of guy.
Yeah, I'm more the do it yourself kind of guy. So if you guys are out there and you've got a good foundation of, well, let's just say it's residential real estate, and you feel comfortable about, lending, let's say $500,000 first trust position on an asset that's worth $1 million, and that asset is definitely worth $1 million, then I would just go ahead and dive head in. I'd dive head first and just do it. It's that simple. But, at the very beginning, like Sam was saying, you got to have your processes in place. And so even when we were starting out in this business, we were literally spreadsheet jockeys. Every one of our loan was on a spreadsheet, and we kept track, and each individual loan, the payoff was on a spreadsheet that had an AM schedule on the spreadsheet. We knew exactly how much money we were going to pay. So, we didn't really have the systems and processes in place. But if you have a strong real estate background, you understand title, you understand how to evaluate, you understand the laws. You really have got to understand the lending laws. So if you can understand all those things, go for it, go do it. But
yeah, it's interesting.
There's some risks.
There's a risk.
There's some risk here. I mean, what if you get involved in BK or something and they think you're on one side of it, but you're on the other?
But again, being like us, we certainly didn't start off with our buddy Eddie Grass as a lawyer sitting at the table, right? Mm-hmm. Because of all of our deals and some of our shortcomings, we realized that the most important person in this thing has got to be a really, really, really good lawyer, because the more deals you do, you're going to get caught with some mud on your face. I mean, there's
just no way to not have
no way around it.
Well, because you're not looking at somebody's background and credit score and history. Sometimes you know it, sometimes you don't. It's interesting. Well, a couple of things I would mention to people, if you're interested in learning more about this, I know the AAPL, the American Association of Private Lenders, you can sign up with them and get their magazine, big glossy magazine, and they write about the different laws. So that I would say find a really good settlement attorney to talk to because they'll understand a lot of this, like how to get title insurance and that CPL thing I talked about. Then there are the weird things that they don't necessarily run into, like bankruptcies and what does that do? And then probably the biggest thing you can get yourself in trouble with is the regulatory stuff. So, issuing a commercial loan to a commercial business, usually there's less rules, but to actually issue a loan to even your brother-in-law, God forbid, you can't typically do that. And it depends on the jurisdiction. AAPL tracks that stuff. But you can violate banking laws if you do certain types of loans. So, and again, so I would say if you're interested in learning more about this, check out AAPL and people like that. Befriend a title person to talk about some of these issues. And if you really think you've got it together, you may want to talk to other hard money lenders, either to go into their fund or to just learn to follow along with them. Maybe they'll throw you some crumbs if they've run out of money and they need some money for a good deal. That's a possibility. And then so maybe talk to a lawyer in the field who'll mentor you a little bit, because it can be reasonably lucrative, but it's not something you want to start without research. Whereas it's much easier, I'd say, if you're going to, relatively speaking, you're going to buy a house and rent it out. Right. I mean, that's better, more easily understood, the risks that are involved with that, is poor Sandra can testify. Some of the headaches, like, I mean, Sandra's not going to lose her shirt, but she's getting the headache aspect of it.
I don't know. A $400,000 loan on $1 million house sounds a lot better than what I'm going through with ants.
Well, that's the other thing that Ed was saying too, is that you have to understand the jurisdiction that you're in, because commercial to commercial lending is different. But then, like for let's say me, if I individually lend to a mortgage on somebody, certain states will allow you to do maybe 3 to 5 a year or 3 a year. There's certain statutes with that. So you really have got to understand the lending laws within the jurisdiction that you're in. And for us, we're primarily in Maryland, DC, and Virginia. Each jurisdiction has totally different rules. We're also in North Carolina. North Carolina has totally different rules. So you really have got to be up on your rules. But if you're doing it one here, one there, one here, one there, you might be okay, but you better check it out. Ed's absolutely right.
Well, isn't it true? Like, we don't have much experience or any experience with, say, California, or I seem to recall reading in some of the AAPL stuff, they're like, stay the hell away from California and Texas, or so.
I think you need to be licensed.
You need to be licensed.
Even to do a basic thing. And
anything,
the most basic, exactly. So, and AAPL, I know they're sort of like, I have a lobbying arm. They keep track. Oh, this state is going to add a new requirement, and they try to get that knocked down. Because it's certainly, there's a lot of to be said for these private loans in the right circumstances, but some states just have more of a regulatory system that you just can't go willy-nilly with this stuff. So.
Okay. Hey guys, we actually have a story that came in. Maybe Ed, you can handle this one. There's a Heidi D or Heidi.
Oh yeah, the question. Yeah, the bankruptcy question.
She's related to Sandra D.
Mm-hmm.
Yeah. Hey Heidi, it's my cousin. Can you please let me know if you can have a domicile in one state, move to another state, stay in that new state for 6 months and get domicile, but file for bankruptcy pertaining to your previous state only, and having it all done in the new state for the old state?
Wow. I do not know the answer to that. And I'll always preface this sort of thing by saying, I am a lawyer, but for listeners, I am not your lawyer. I always suggest you can, but what we talk about here, just like and I'm happy to answer as best I can, but just like the discussion we had of DIP financing, these are all general principles, and hard money lending, you got to find out specific to you. So there's sort of 2 issues to consider here, at least. I can give some ideas of what to look into. Generally speaking, so there's residency and domicile. So I currently have a residence where I live, and that also happens to be my domicile, which is sort of the personal place to which I will consider myself always to return. Now, originally I grew up in Pennsylvania. That was my domicile, but I temporarily resided in Massachusetts while I was in college. but my domicile remained Pennsylvania. I wanted to go back. So the question is presented, though, is I want to change my domicile. And there's a lot, actually, picked from the news. Donald Trump just changed his domicile from New York to Florida. He said, I'm going to live at Mar-a-Lago now in Florida. That's going to be my permanent home. That's now my domicile. I believe that's what he's been doing. No longer, his longtime domicile was New York, even though he had properties all over the world. So there's an intent element to that. It can get a little, and it can vary for different issues. So and I don't know that you necessarily have to take 6 months. I mean, if I bought a house right now in West Virginia and made that my residence and moved there, I think I can pretty quickly just say that's my domicile. I'm now West Virginia domicile. Now, in terms of bankruptcy, I don't know where you're allowed to file bankruptcy if it's purely based on your domicile or residence. It may be based on some of your assets. So I'd have to look it up. Maybe I can, for next episode, look this up a little bit more. But if in my scenario, I had my Virginia house right now, I moved to West Virginia, I now set up a new domicile in West Virginia. I've still got both houses. And I go, I've overextended myself with these two houses, and I declare bankruptcy. Would I have to do it in West Virginia or is it an option? I don't know the answer to that question. And a bankruptcy, that's actually a pretty basic question in many ways, but I don't really do that sort of thing typically. My guess would be you might have an option because you have essentially assets in both locations. Now, it'd be much simpler if I was always in Virginia and I had a Virginia house and my domicile stayed here, my assets are mostly here. No question I would file. And you can file in state or federal court, but most people go to the federal system because it's better. Typically, you would file in federal court, again, depending on your situation. So I will leave that open about, I should be able to figure out pretty quickly about generally what your options are at that point, but talk with a bankruptcy lawyer. Another thing I can tell you is for a basic bankruptcy, you can hire somebody and pay them by the hour to answer questions like that. And they also have a lot of times these no-look fees where somebody will say, I'll be your bankruptcy lawyer for $5,000 flat. And if it turns out you have a complex bankruptcy, that's my problem. If you have a simple bankruptcy, maybe it's easier if you would have paid a little less if it was hourly. So that's another way to find a bankruptcy lawyer. And the way to do that is call your local bar association. So if you're in my scenario, West Virginia or Virginia, you can call the Bar of Virginia or the Bar of West Virginia and say, help, I need a bankruptcy lawyer. And they will actually give you a list. Or near where you live, there's 10 bankruptcy lawyers, and they'll give you numbers to call. So that's a lot of people are like, how would I even find a lawyer? So in any event, you can tell I could go on for days, but that's great to have that question. I'll find out a little bit more for our next show. And, maybe hopefully Sam won't have any more X-rated basement tales to slow us down.
Yeah, hopefully Sam will behave.
No TAILS is for me next time.
So if you guys like what you hear, please like us. Please subscribe, tell your friends. You can send us an email like Heidi did, yourstory@basementtales.com. That's with 2 T's. Again, yourstory@basementtales.com. TALES, as opposed to the other one. So as Sam explained earlier.
And if you don't want to miss we're going to call him Sam's XXX Corner. Don't forget to subscribe so you don't miss any tale of any sort. Be sure to hit that subscribe button.
All right. Thank you.